Hello, this is chapter 8, first video of 2. So we're going to be using our contribution margin model in some very specific situations. So let's take a look at the different situations. So this chapter is mainly focused on 4 or 5 particularly interesting short-term questions. If you are running a factory and someone comes in with a special order, should you take it or not? Should you discontinue a product or not? Should you improve a product or leave a product as is? And various kind of special case scenarios. So if you look at previously, we had focused on break-even decisions, target profit decisions, and some other sort of supplementary things like margin of safety, but primarily what is the break even and what is the target profit, either units or sales level. Here we are doing a couple of very specific questions. And although the information may look a little bit like it's more information, really each one of these special cases has, I don't want to say a trick, but a very specific thing you need to look at and understand to see how to evaluate it. Before we get into the special cases, so we're going to go over 2 of the special cases today, a special order and whether or not to discontinue a product, but we need a couple of, vocabulary or ways of looking at things. So the first one is going to be the idea of relevant information. Now we have previously, very long time ago in the first couple of chapters, talked about relevant information, but we're going to bring it back up today. And the idea is, when we're making a decision between 2 different outcomes, we really only need to evaluate what is relevant and what is not. And how this is going to play out, we will see. But almost all of these special situations have some sort of idea of only focused on the relevant information. So relevant information, you may have a lot of different descriptions of it, but remember, relevant information regards two or more outcomes, right? Or decisions. And whatever is relevant is something that is different between them. So relevant really is focused on what is different. If it's not different between the 2 outcomes, it's not to say that it's not a cost. It's just that it's not relevant for the decision. So here, in the first question, they have a question and a bunch of just trying to identify. It says indicate, and I've kind of reduced the question here, indicate the cost would be relevant or not to the company's decision about purchasing new machinery. So first identify what are the 2 outcomes. You either purchase the machinery or you do not. Those are the two different scenarios, and you have to look at each piece of each of these items and determine if between the 2 scenarios that information would change, it's relevant. If it would not change, then it is irrelevant. So for example, the book value of the old machine. Now, whether you buy a new machine or do not buy a new machine, the book value of the old machine will not change. So that's not relevant. The interest expense on the new machine. Well, obviously, if that would be different between the 2 scenarios, because if you decide not to purchase a new machine, there would be no new interest expense. If you did buy the new machine, there would be interest expense. So that would be something we would be calling relevant. Variable selling cost. Well, if you purchase a new machine, all your sorts of incremental variable cost will change. And this is actually maybe one of the most, telling things. I didn't put it here, but almost always in these, we call this incremental analysis. That almost always we are going to have to make a decision on whether or not the fixed costs are relevant or not. And typically they're not. And that will make the decision a lot of times on, if we're only considering variable costs as relevant and not the fixed costs, that will change how we look at a situation. Installation cost of the old machine, well, obviously that doesn't change no matter what you do going forward, but installation cost of a new machine. That would be a new cost and would be relevant. It would be something different. So when you go through down the list, rather than guessing, just make sure you understand the purpose of relevant. Relevant is saying, okay, not that the information doesn't get added in at some point, but for your decision making, relevant information is what is the information that is different between the two outcomes. The second concept that we need to look at is, although we're not going to pull it in probably in today's, is the idea of cost plus versus target pricing. Now, if you've worked in retail, you've heard of cost plus. It's cost plus. All that means is whatever the cost is, you add on whatever your margin or your profit is going to be. Now, situations where you can use cost plus is that you've got a unique product or a desirable product to where it doesn't matter as much what the cost is. You just want to, you can charge, you have a fairly wide range of what you can charge, but you want to make it however you want to make it, and then add, I guess the thing you want to secure is you want to secure the amount of profit that you make on it. So cost plus margin is typically for unique or good products or, you know, more desirable products. Target pricing, well, that's where you have a lot of competition, or it's more of a common product, so that, you know, for example, if you're selling dish soap, maybe dish soap, all the other brands are $1.99. Well, if you start selling yours at $2.49, you're not going to sell much. So what you need to do is you need to target a cost of $1.49 and then back figure all your, so this would be the sales price. Target a sales price of $1.99 and then work on reducing your costs. And so have you ever so an example that I always look at is when I buy razor blades, they used to have 5 razor blades in a package. And nowadays they have 4 razor blades, but the price is the same. In other words, they didn't say, oh, well, you know, it costs more to produce 5, we're going to just increase the price. They know their customers are used to 5 razor blades in the package, or they're used to a certain price, and what they've done is reduce costs by reducing the amount in the package. And you can see that with a lot of things. How many times have you bought something and it's a smaller size, but it's the same price? Well, that's an instance of target pricing. So we're actually going to focus on cost plus here. And the example that we have is this ski resort. So we've got some information about what the investors want to earn, the projected costs, how many skiers, and this, that, and the other. Should it use cost plus or target pricing? Well, here's one of the things. Favorable reputation. Even if they didn't say favorable reputation, we would just think ski resorts are probably pretty different from resort to resort. So even if it didn't say this one particularly has a favorable reputation, we would still say that they're probably unique enough that within a band you should be able to charge what you think is appropriate. Now, if you're talking about like a taxi cab, you know, that's a target price, and you probably can't overcharge too much because people can just go and do a competitor. So here we would say we would use cost plus for all the reasons that we were talking about before. So now we go in and say, okay, if we charge $65, or I'm sorry, if other resorts charge $65, what should we charge? Well, we're not going to. 65 is okay information to understand. So if we were doing target pricing, we would have to work backwards from 65. But what we're going to do is going to say, nope, let's look at what our costs are and then make sure we mark it up the appropriate amount. So we're going to take our fixed costs here, which is 33,750, and we're going to say plus our variable costs. Now, what are our variable costs? Well, we have 750,000 skiers, and we're charging each of them, that may be whatever it is, if it's electricity or tickets or whatever, but whatever the variable costs are that we've worked out. So that's going to be 7.5 million. When we add those up, that comes up to 41. I probably should have made this box a little bigger. 250,000. Now the desired profit, okay, so this is the cost, right? And then this is the plus. How are we going to figure out the desired profit? Well, it's this first thing right here. Investors want to earn 15% on 100 million in assets. So 15% on 100 million assets, that's what they're saying is they want us to earn 15 million. So 15 million, when you add those up, you're going to say, okay, the total revenue that we're going to shoot for is this, 56 million. That's because that'll cover the 41. It'll cover the 41 and it'll cover the 15. Well, how many skiers? Well, we're projecting 750,000 skiers, right? So if we're projecting 750,000 skiers, we're going to charge, and you work all those numbers out, it ends up becoming 75. So other resorts charge 65, but we're going to charge 75 because we're doing a cost plus, because we feel A, that we have a favorable reputation, and B, that we, well, it's a differentiated product. Ski resorts are going to be different just by nature. Now, if this came up to 130, well, we might consider. It seems like it's in a fairly relevant range, or fairly decent range, but we would still, it's not that unique a product. We still can't be too far away. So we would still consider a few things. We would still look at this and make sure, yes, cost plus is the right way. 75 seems reasonable, but we would still maybe track what other resorts are charging as well, just to keep a handle on things. So those are kind of the two basic ideas. Let's look at our first special order. Our first special case scenario. And the first special case scenario is a special order. And this has to do with, okay, you've got a factory and you've already figured out your fixed cost and your variable cost and what you're charging and everything else. And yet you still have some spare capacity. So here you can see 70,000 is our total capacity. We're running at 55,000. So you can see we've got 15,000 of spare capacity. And we did learn in the previous chapters that you want to be you want to be pretty close to capacity, because you're spreading your fixed cost over more units. And when you spread off fixed costs over more units, your average price goes down. That's what we call economies of scale. So we have some extra capacity here. We've got some information: variable cost per unit, fixed cost, and selling price. So we have all that information. A person walks in and says, hey, I want to order 10,000 units. Well, A, do we have capacity? And the answer is yes. They want to charge $25. Well, you say, well, our selling price is they want us to charge, they want to buy it for 25. Well, you say, well, our selling price is 45. I'm not gonna do that at all. Well, the truth is, remember the idea of relevant costs. When we look at the difference, the relevant information, when we look at the two scenarios of taking the special order versus not taking the special order, right? Those are the two scenarios. We want to evaluate what are the differences. Well, this fixed cost in the end is not relevant. And why do I say that? It's because even though we figured it out as a per unit cost, what we're saying is 55,000 times $4.10, our current production covers all of these fixed costs. In other words, any new production, any extra production, there's no fixed cost for it to cover. So really the only costs that you have to cover are going to be the variable costs. That's like saying, remember we were talking about a little bike production shop. Let's say we have a capacity of 100 and we're making 80 this month, so we have 20. Someone wants to come in and buy 10 extra. Now remember, that 80, we've already figured out how to price those 80, because those were our regular units, to cover the rent. In other words, the rent's already been covered with the 80. So any extra, we just really want to say, can the extra ones cover the costs of building the extra bikes, because we've already got the fixed costs covered. So just be aware that the fixed cost here is not relevant. So when we do our incremental analysis, we're going to say, what is our revenue from this? In other words, incremental analysis looking at the relevant information. An order of 10,000, well, we would get an extra, this would be different, right? We would have 250,000 extra revenue. Are there any expenses? Well, we don't have any extra information here. It doesn't look like there's any extra information. Now, what would the variable costs be? Well, variable costs are 30 per unit times 10,000 units. So this would be minus 300,000. So this would be, we would lose 50,000. And the important thing is here to remind, and so are there any other fixed expenses? No, so the total loss would be 50,000. But the important thing to note here is we didn't consider this at all. All we did was match will the price cover the variable cost. You can see that's almost the direct relationship. Now, a lot of times these things have a couple of other special items, and we gotta take into account those special items. Sometimes there's extra fees or setup costs and this, that, and the other. But the most primary thing you need to look at is A, fixed costs are not relevant, and B, will the special price cover the variable cost? Because if it doesn't even cover the variable cost, then it's almost a no-go. And there's a couple of situations that they could make it work with, added in bonuses or whatnot. But the first thing you're going to look at is special price versus the variable cost, and that will tell you a lot. And in fact, some of these other scenarios are going to kind of get at that. So the answer is, would we accept this? No, we would not accept this. We would tell them you had to do a couple of things. I mean, we would have to do something. You have to do something to make it worth our while. Either increase the special price, the special order price, or something. So here, something similar, that we've got still 10,000 units. Now the special price has gone up to 40. Well, that's a big jump up from 25, right? Was 25. But there are extra fees. There's extra fees with this for exportation. There's some export fees. So now our question is, yes, the special price, remember our variable cost is 30. Just looking at 40 versus 30, we would say, yes, this looks fine. But we don't know if that extra $10 increase will cover the fees. So that's what we need to do. We need to check that out. So the revenue from a special order, well, that's going to be 400,000. Less expenses. These are kind of variable expenses, no variable expenses. The variable manufacturing cost, well, that's the 30 times 10,000 units. So the contribution margin is 100,000. And we can see we do have some fixed expenses. In other words, we call the fees a fixed expense because it doesn't change with the level of production. So we would make 85,000, and most of it comes from the fact that the special price is bigger than the variable cost. So here, would we accept this? Yes, we would. So there is a situation where, and I'll point this out, there is a situation where you do not have enough capacity. When you do not have enough capacity, you have to make the decision based upon whether or not you're going to make more than your current production orders. And that's usually a special case scenario. So just realize this all works if you have capacity. If you don't have capacity, then you're basically substituting out the new special order for your existing order, and you have to make a somewhat different calculation. Again, I have no idea how this happens, because literally I check right before I start. There's something about the pad that inserts these further on down. Okay. And it seems to be just one page worth. Yep. Okay, we're continuing on to the second special case that we're going to cover today, and that is whether or not you should discontinue a product and what should you look at. So if under the first one, under the special order, we really wanted to check the special price, the special order price versus the variable cost. That was our primary frame of reference. Here, we're going to be looking at something different, and I will show you. So you'll get a lot of information, and it'll seem a little overwhelming, and it'll be hard to make a decision. But actually, the decision making is pretty simple in this. So here we've got a factory capacity of 70,000, production, variable costs. Okay, so a bunch of this stuff. And we have a set of information about flooring. I actually think this is left over from the other one. We have two product lines, a wood flooring and a laminate flooring. And you notice we've got sales revenue for each, the variable expenses for each, and the contribution margin for each. So remember, these are by category. These here, this top, the sales and the revenue. Now this, all the fixed expenses, those don't change between situations, right? You're typically stuck with all the fixed expenses. The variable stuff, like the sales revenue and the variable expenses, change, but the fixed expenses typically do not. In other words, we should be focusing on this is the total amount of fixed expenses, no matter how we allocate them. So someone has allocated 75 and 55, whether that's right or not, we don't know. Someone's allocated 51 and 19, we don't know if that's right or not. But the total amount, this is the total amount of fixed expenses. So the question is, will discontinuing laminate flooring help? So most people initially just go here and say, oh, it's losing money, and I'm going to discontinue it. So the way to do it is we do incremental analysis, and we say, okay, how much margin would be lost? In other words, it's generating this amount of margin right now. So we would lose 46,000. Now, if we dropped the laminate, we would still keep these two items, right? At least that's from the information we have. We don't have any information that we would drop any of the fixed costs. So all of these fixed costs would have to be put onto wood, right? So even though if we discontinue the line, we would still have these fixed costs, we would just have to have wood take care of all of them. So there aren't any savings. So we would say we would actually lose income in the tune of 46,000. And so what do I mean by that? So you can see that the fixed costs here are a total of 200,000, right? The total fixed cost. If we eliminated laminate altogether, and we just said, okay, we've got wood, which contributed 150,000 in sales, so this would be 150, but we'd have total cost of 200,000. Well, then you can see that we would be under by 50,000. So what we say instead is, it doesn't matter. I guess it matters less whether or not the operating income is minus or not. This number is really dependent upon how someone has set up these fixed costs. If they spread them evenly or if they didn't spread them correctly, but no matter what happens, you can see this is 74,000 in fixed costs. No matter what's going on there, at least laminate is reducing that fixed cost by 46,000. In other words, sure, it may not still be profitable as a category, but it's at least reducing the amount of fixed costs that we're taking on. So we would say, should we drop it? No. Because at least it's helping pay for some of these fixed costs. If we didn't have this 46,000, we'd have to have the other category pay for all of it. So here the trick is to not look at the operating income. It is to look at the contribution margin by category. the divisional contribution margin. There's lots of different words for it. If this is positive, at least it's contributing. At least it's contributing something. So we're going to do the same thing, but we'll look at a couple of different scenarios. Assume you can avoid $32,000 of fixed expenses. Okay, so the same thing is going on, except now we're saying, okay, we're not going to have all these expenses. We can actually avoid some of these expenses. But is it enough? There we go. Is it enough? Well, we can do our incremental analysis, and the answer is going to be no, but we can do our incremental analysis and say we would lose 46,000, but we would gain 32 back from fixed costs that we didn't have to pay, but we would still overall be losing 14. You can say, okay, yeah, we're losing this, we're gaining this, but we're still losing overall. So no, we would still not drop it, even if we can avoid a certain amount of fixed cost saving. The amount of margin that we're getting from the line is more than the fixed cost savings. Now we've got a third scenario. Assume laminate fixed costs can be avoided altogether. So what they're saying is all of these can go away. Well, okay, maybe yes. But there is a penalty. There is a added effect. Because we're not selling a full, both lines, the wood flooring line would also suffer a 10% decline. So we would lose 46, right? So we'd lose 46 here because we'd lose that margin. Wood flooring contribution margin loss. Well, it says 10%, right? So what is the contribution margin right now? Contribution margin right now for wood is 150,000. So we'd lose 10% of that. So 10% of that would be 15,000, right? So we'd also lose that. So right now we're losing 40, 50, 61, right? These two are saying we're losing 61,000. But we're getting back something. What are we getting back? We're not having to pay for this fixed cost, which is 55, 75, 74. So we're actually gaining because we're avoiding all those particular fixed costs. We're gaining 74. So as you can see, we're losing 61, but we're gaining 74. So we're overall gaining 13,000. So we will be gaining operating income, and we will say drop the line. So the primary thing we're looking at is the contribution margin. And the second thing we're looking at is what is the effect to the other costs, the fixed costs primarily. So lots of information, but there's actually some fairly simple, straightforward ways to evaluate these things to understand what's going on. Okay, we will finish up video chapter 8 with a second video and go over the other, I think it's like 2.5 additional special cases. As always, if you have questions, send me an email or visit me during the Zoom office hours. Thank you.